Hello everyone, welcome to Sharp Finance. Today we'll be looking at Alteryx ticker symbol AYX. We'll try to determine if the stock is actually overvalued or whether it makes for a good and solid long-term investment. As I'm recording this video, it's actually the 7th of November 2020, which means that Alteryx has just reported their Q3 results. And what we've seen in yesterday's trading is the price has taken a massive dive as a result of that, going from $145 to $115 at close. This represents a 20% drop in a single day, which even for such a stock like Alteryx, which has quite high levels of volatility, it's still huge. And to understand the reasons for this change, what we will need to do is we'll need to take a look at the Q3 press release. And just before we do that, I just want to mention a couple of things about what Alteryx does and remind you about their business. So Alteryx is a company which makes data analytics software, and it aims to make processing big data easy. So it sells this software to large enterprise companies on a subscription-based model. So it's built up a nice chunk of recurring revenue over time, which stands at $450 million to be precise. And once a client is subscribed, it's unlikely that they will drop off because Alteryx has actually proved to have quite good retention rates. Its core product, the Alteryx Designer, basically allows you to cleanse and prepare data for it to be imported into visualization software, such as Tableau or Power BI or many other. But what appears to be the issue in the market right now is that there's no software that does what Alteryx does as well or in such an easy manner. So in my view, there's actually no competitors, no direct competitors at least. Without oversimplifying, you don't need to write a single line of code or be an expert in data analytics to use this software. This software is meant to upskill the workers of large corporate entities, and it's meant to do so in a way that makes Alteryx a lot of money. So from my experience, the software is actually really good. It's extremely useful and they're making improvements, but it's good to know that they already have a sound product which is not over-engineered, which does what it's meant to do, and it works quite well. The company was actually launched back in 1997. It was originally called SRC, and it started by creating a range of software that was meant to handle geographical or so-called spatial data. They changed the name to Alteryx in 2011, and they have around 1,500 employees and 7,000 customers. But what's important to note is that those 7,000 customers are actually really big companies. Many of them are part of the Global 2000 or, S&P 500, FTSE 100 in the UK, and so forth. So they actually do have very reputable client list, as you can see on the next slide. Even though this is really impressive, I still think that they have a lot of scope to grow. They could focus on middle market or SMEs as employees from these large enterprises go to smaller businesses or in fact open their own. They will be looking forward to using the tools that they have learned and that they are good at to manage and handle data. So overall, I think there's still huge potential to grow within the enterprise market, but also within the smaller, medium-sized markets as well. Okay, so let's have a look at the press release that the company has published. And what we will see is that on the face of it, the company has had quite a good quarter. The third quarter revenue was $129.7 million, which was 25% higher than the same quarter of last year. And this was actually higher than the expectations. So the consensus was around 124 to 128 million. So this was a positive surprise. Similarly, annual recurring revenue was approximately 450 million, which is up 38% year over year. When we look at the P&L in more detail, we can see that they made a gross profit of 120 million and roughly 92% in gross margin, which overall are very impressive numbers and are consistent with what the company has observed over the last few quarters as well. In terms of income from operations, that's where we see a massive drop, and that's because obviously of the massive fixed costs that Alteryx is incurring, such as the selling and administrative costs and so forth. And this resulted in 9.6 million of income from operations compared to 12 million in the same quarter last year. However, when we look at net income, they actually made a profit. So they were up. They made 4.4 million in the period compared to a loss of 6.2 million last year in the same period. So overall, very good numbers. And most importantly, when you look at the non-GAAP net income per share, so per diluted share, they reported 0.39 cents. Now, this is very interesting because the consensus, the expectation was around 0.20 or 0.25 cents. So again, a positive surprise, and still doesn't explain why the price share dropped so much. In terms of its balance sheet, they say they had around 982.5 million of cash and investments, which is more or less in line with what they had on December 31st, 2019. Similarly, they said that the business has generated cash for the first 9 months of 2020 of 16 million, which is interesting because they don't say they didn't publish this quarter's amount, which if we look down below, if we look at the cash flow statement and we look at the net cash from operating activities, what we can see is that in the 3 months ended September 30, which is this quarter, of course, they have made the 9.6 million of cash. Now, this is very important to me because as a growth company, which which you could say is struggling under the current situation due to the cuts in enterprise spending, the fact that they still made that they are generating cash rather than burning it is a very good sign. This is something rare for a growth company at this stage in their development. Now, in terms of balance sheet, they had 627 million in short-term investments, presumably treasury bonds or similar investment mechanisms, things that could be easily converted into cash. So overall, 723 of cash and short-term investments. And also we see significant long-term investments of 260 million, making up the balance of 1.3 billion of total assets. In terms of liabilities, we can see that the most significant bit is long-term debt. And it's actually, the amount is not that scary. 650 million, they could repay it straight away with all their cash, but of course that would leave them with very little cash on hand. Now the question is whether this limits the growth that they can have over the long term, the amount of risks they can take, and also the amount of flexibility that they have as a growth company. And so this is one concern, but given the size of it, I don't think it's an issue. And you shouldn't be worried about it, but it's just something to note and take into account. So overall, 435 million of net assets, which shows that they have a decent balance sheet as well. In terms of other metrics, they had 7,000 customers, 24% increase, added 240 customers in the quarter, quite impressive. Net expansion rate, 124%, which basically means that for existing contracts, they have built 24% more, so they had 24% growth within existing customers. At least that's how I understand it. And then they ended the quarter with 450 million in annual recurring revenue. Like I said before, 38% increase year over year. And now this is quite important because it shows that they still have a significant amount of recurring revenue. Recurring revenue, of course, is the amount that they are expected to make in the next year based on yearly contracts that they currently have, and so forth. So overall, very good results, and it just begs the question of why the stock has dropped so much, right? If you don't get it by this point, then things are strange, right? So we get to the fourth quarter 2020 here. And what we see is that revenue is expected to be in the range of 146 to 150 million. So this is actually higher than the current quarter, right? Current quarter was 130 million. So 20 million upside or thereabouts. However, this is still lower than the last year. So this is where, it becomes a little bit tricky. So last year they had a great Q4 and they are expected to this is actually expected to decrease when you compare it to last year. And to me, this appears to be the main reason, together with the fact that they reported net income, under non-GAAP net income per share, of 0 that they and the other reason is that they expect non-GAAP net income per share to be in the range of 0.27 to 0.31 cents, and analysts expected this figure to be in the range of 0.4. So if you look at it that way, you can kind of start putting the pieces together and see that analysts are mainly worried that, there's a slowdown in growth from the pandemic, from the situation that's happening in the world, and they are more worried about this because as a growth company, it's very, very important for Alteryx to maintain the kind of growth that it's experienced over the last 2 years. And it's whenever this, the swings in expectation happen, or whenever the company deviates slightly, what we've seen in the past is that the stock experiences massive price changes, and this potentially could be a good opportunity to get in. The stock was launched around $14 back in 2017, and it went up all the way to 150 in September of 2019. However, we've seen this huge fluctuations. It went back all the way down to 80 in the 80s in October of 2019, then all the way up to 180 again, and then fell down massively here in March of this year. This was not purely, this was mainly due to this, the market, and then had a great run up to 180 again, and then fell down significantly due to bad results, quarterly results that, were a little bit underwhelming, and, again, had massive jumps when they reported that they're changing their CEO. And now again, we're seeing the same old story, massive drop like we've seen here, massive 20% drop in one day. So to me, this pretty much looks like a buying opportunity if I'm being honest. Now, there are a few things that you need to be aware of, right? So the market cap of this company is 7.64 billion. The PE ratio stands currently at 231. And that will sound crazy to most of you because I actually think is undervalued, right? So when you look at the PE for the next 12 months, it's still predicted to be quite high, 174. However, you do have to keep in mind that the company is only generating very mild profits at the moment. The reason I think it's undervalued is it's as a data analytics company with recurring revenue, it's a very stable business. Once the business has adopted the technology, it's very unlikely that they will switch it off completely from using it. Surely they might take some cuts, they might not expand their memberships, they might take a step back, in the current situation, just to make sure, that they can cover their main expenses, because this could be seen as a luxury product in some way, right? However, when you think about it long term, the strength of the business hasn't changed. Data is here around to stay, right? Big data is gonna be a problem that large enterprises are gonna be facing for the next decade or so, at least, right? So they will need to find solutions on how to handle big data, how to upskill their workers, and how to reap the benefits. And therefore, I think there's still tremendous growth and tremendous potential for Alteryx in this environment. I think the situation that's happening around the world, the lockdowns are affecting it, will affect it, but nevertheless, I think it will come back and the effects should not be too high. So all in all, I think I would encourage you to do your own analysis and look at the financials in more detail and make sure that you, of course, do your own due diligence. But I would strongly recommend that you look at it from the growth perspective and from the potential that this company has. As I mentioned, I do believe in their product. I have to say I'm not affiliated with them in any way, shape or form. I do not have any inside information or anything like that. So I do take everything that I say with a pinch of salt, and please do your own analysis. But overall, I recommend that you look into the company, especially now after a 20% drop in price. It makes for a very good long-term investment. However, you do have to be ready for the levels of volatility that we've seen, and you have to be ready to live through that and not panic. So this is definitely not an investment for the lighthearted, but if you're looking for great returns, I think this is a very solid company to look at. It's in that stage of its development where it's not too small to be too risky, but it's proven its product and it's proven that it can scale, right? But it's also not too big, so you're not coming in too late. So I think it's kind of in this Goldilocks zone right now, which is why I'd be looking to invest. And, I'm actually already invested in the company, but I'm looking to grow my position and, increase my returns potentially. So thank you very much for listening. This is actually going to be my first YouTube video. So if you have any feedback, it'd be massively appreciated. If you want to subscribe for future videos, I promise they'll get much better. So please subscribe, like this video, and thank you very much for watching.